Hi there. In this topic video we're going to be focusing on floating and fixed exchange rates. The choice of exchange rate regime or system is one of the most important that a country can make as part of their monetary policy. So we're going to explore the difference between floating and fixed exchange rates and also look at managed floating as well. So first of all, floating exchange rates. In a floating system, the external value of a currency depends wholly on market forces of supply and demand. There's no intervention in the currency markets by the central bank. The central bank allows the currency to find its own level. And crucially, the external value of the currency, for example, the value of the pound against the dollar, is not a target of macroeconomic policy. That's a floating exchange rate. Lots of countries still have free floating exchange rates, or pretty close to it. The UK has a floating exchange rate, so to the Australian dollar and New Zealand, and also in Poland there's zloty. So Poland is inside the European Union, but it's outside the single currency at the moment. It has a floating exchange rate. Here's a good example of a floating exchange rate in action. So the value of sterling against the US dollar. Notice how sterling fell or depreciated more than 20% in 2008 through 2009. It recovered a little bit of ground and fluctuated around $1.55, $1.60 for several years. Floating currencies don't have to be volatile, but in recent times the pound has been falling, depreciating against the dollar. The dollar's been appreciating. So the pound has gone down from about $1.70 down to around $1.40 as we speak. Now in a managed floating system, a managed floating currency system, most of the time, day to day, the currency is set by the markets, by the foreign exchange dealers. So the central bank will give the currency a degree of freedom to move on a day-to-day basis. However, occasionally, some currency market intervention might be considered by the central bank as part of a demand management strategy. So, for example, they might decide they want the currency to go up, in which case they will go into the market and start buying their own currency and selling foreign currency reserves. They may decide, on the other hand, that the economy needs a lower currency, perhaps a depreciation to raise exports. Well, this can happen if they went into the market and sold their currency and bought foreign exchange in return. In a managed floating system, the central bank can also use changes in interest rates, because we know that the relative interest rate on bank deposits is a factor causing inflows and outflows of hot money. Now, in a managed floating exchange rate system, the exchange rate becomes a target of policy. It's seen as being instrumental in just shifting the economy in a particular direction. So a country that wants, for example, to get inflation down might favour an appreciation of the currency. A country that has a trade deficit and maybe a recession or a deflation problem might try to bring their currency down in value. That's managed floating. And increasingly we see countries moving towards managed floating, particularly developing countries who want to manipulate their currency in a particular way. The Brazilian real is a managed currency, the Swiss franc, Japanese yen, those of you who've been following Abenomics, Norwegian kroner, and the cedi from Ghana. Increasingly, countries are moving towards managed floating exchange rates. Here's an example of a currency that's managed. The Swiss actually basically kept or tried to maintain a more or less a fix against the euro from around 2011, the latter months of that year, through to the end of 2014. It became really difficult though to maintain that fix. There was strong pressure in the markets for the Swiss franc to appreciate against the struggling euro, and eventually the Swiss central bank decided to lift the cap on the Swiss franc, and as you can see what happened, pretty much immediately the Swiss franc went up quite significantly against the euro. It's fallen back a little bit since, but essentially it's gone up from 0.83 to about 0.92. Now, a fixed exchange rate is the opposite of a floating exchange rate, and in a fixed system the currency is pegged. There are no fluctuations in a fully fixed system from the central agreed rate. So in a fixed system, the central bank, nearly always operating on behalf of the government, operates a fixed or anchored exchange rate. The pegged rate becomes the official rate, and most of the time People buying and selling currencies, trading, investing will happily trade at the official rate. Although, of course, in many countries there might also be some unofficial trades, if you like a shadow currency market, where people deal in unofficial prices. The currency in a fixed system can change, but for that to happen, the peg would have to be altered. So we call this, if you like, the adjustable peg idea. For example, a country might decide to devalue their exchange rate, or they might decide to revalue. So China in 2015 opted to try to devalue the yuan against the dollar, and the Russian government has also devalued on several occasions recently. Here's a good example of a fixed exchange rate. It's the Danish kroner, essentially fixed against the euro. Denmark, of course, is inside the European Union, but it's outside the single currency. For many years, they fixed their currency against the German Deutschmark. But now, of course, the Deutschmark is gone for the moment, and the euro is the currency in the European Union. Now, some of you were thinking, wait a minute, Jeff, that doesn't look much like a fixed currency to me. What are you on about? Well, of course, look at the scale on the y-axis. It looks like a volatile currency, but actually, if I just superimpose some numbers, the Danish currency against the euro has fluctuated 0.6%. I've done the maths, by the way, against the euro over the last 5 years. In other words, it's basically been fixed. When the governor of the Central Bank of Denmark wakes up in the morning, his first thought is, I need to keep the Danish kroner fixed against the euro. I need to intervene maybe occasionally to make this happen. And when he goes to bed at night, he dreams of maintaining a fixed exchange rate against the euro. Such is the exciting time of the central bank governor of Denmark. Now, what about the case for floating relative to the case for fixing? As I said, this is a key choice that governments need to make. Some of these arguments get a little bit complex, but bear with me, they're worth thinking about. Why might a country go for a floating exchange rate? The first point is that if you have a floating exchange rate, you don't really need much in the way of foreign exchange reserves, because you're letting the currency find its own level. And a really crucial point, if you go for a floating exchange rate, then that allows you to set interest rates, Monetary Policy Committee for example, to meet your domestic needs, to meet, for example, controlling inflation or controlling the cycle. So because you're not having a target for the exchange rate, that allows interest rates to be set for other macro objectives. A floating exchange rate can help to prevent imported inflation. So, for example, it could be the case that there's a rise in the cost of imported products, but the exchange rate might move in the opposite direction to help absorb that. Case in point, in 2014, the price of oil was quite high. We import a lot of oil, but the pound was actually appreciating against the US dollar, so it made oil a little cheaper at the time for us. I think a really key argument for having a floating exchange rate is that a floating currency provides a degree of insulation for countries that are export dependent but vulnerable to external shocks. So take, for example, a country that's exporting oil or gas, and the world price of those commodities goes down. Your export sector is going to take a hit, and you may well suffer a worsening balance of payments position. Well, in that situation, the floating currency is likely to depreciate, and that should help you to sell a bit more oil and gas overseas, but crucially it should also increase the competitiveness of your other industries, maybe car making or steel making or farming, for example, commercial farming. You might be able to sell some more output. So countries where there's a shock may see a currency depreciation in a floating system, and that kind of increases the potential for selling exports from other industries. Those of you who've seen our topic video on the J-curve and the Marshall Lerner condition will know that a floating currency helps to provide a partial, sort of automatic correction if a country is running a big trade current account deficit. Because if a country is running a deficit, the exchange rate tends to fall and restore some competitiveness. Floating currencies tend to be less at risk of attack by speculators, because basically the speculators are just, they're interested in attacking the weakest fixed exchange rates. And a fixed exchange rate might actually conflict with other macro objectives. Perhaps you've set the fixed rate too high, you end up with some deflation, or you've set it too low, or you end up with a boom in the economy. Floating exchange rate, in theory, should go with the cycle, of interest rates and help to stabilise the economy. What about a fixed exchange rate? So some countries decide, yes, actually we're going to go for a pegged or anchored exchange rate. We want some stability in our currency. And I suppose one of the key advantages of that is that if people know what the currency is going to be worth going forward, that creates confidence. So the good people of Denmark pretty much know what the Danish kroner is going to be against the euro. If you're looking to invest in Denmark from other parts of the European Union, for example, you have that certainty about what the exchange rate is going to be. And that could well stimulate some inward investment. A lot of people have to hedge against currency volatility. They have to buy their currency weeks and months ahead. Of course, if you know what the exchange rate is going to be, there's less cost of hedging. And this is quite an important point, the third point on our slide here. If you have a strong fixed exchange rate and you are fixing against another low inflation country, then businesses know that they've pretty much got to keep their costs and their prices under control, because they can't rely on a depreciation to make themselves more competitive. A fixed exchange rate which is credible and stable leads to less risk in the markets, and actually that could lead to the government having to offer lower interest rates on their debt, which can be quite important. And a fixed exchange rate also does place a lot of responsibility on governments to get their macro policies right, because if they allow the economy to grow too quickly or inflation to rise too fast under a fixed exchange rate system, jobs and investment and incomes will be hit pretty quickly. Last point is that if the fixed exchange rate is credible, if the market's accepted, actually there's often less speculation because people just trade at the prevailing exchange rates. But there's arguments for and against both. And the managed floating system, if you like, is a little bit of a hybrid. So you're trying to get some of the advantages of fixed exchange rates through exchange rate manipulation, some of the advantages of allowing the currency to float. Almost there on this one. One of the points we've mentioned is that if you have a fixed exchange rate system, you're pretty much going to need some hefty reserves to intervene in the currency markets. Japan and China and Switzerland are the countries in the world with the biggest foreign exchange reserves. I mean, China's case, it's astronomically big, over $3.4 trillion. Japan over $1.2 trillion. So those countries typically, they do intervene a lot in their currency markets, and they need those reserves of foreign currencies to make an impact in the markets. Go right to the top of the table. Ireland and Greece, of course, are part of the single currency, so they don't have to intervene in the currency markets because the euro is a floating exchange rate. But even if Ireland was going it alone, for example, and moved back to the punt, or if Greece moved back to the drachma, that's not beyond the realms of possibility, of course. Then they'd have to probably have significantly bigger foreign exchange reserves than that, unless they were prepared to allow their currencies to float freely. UK's currency reserve is about $155 billion. Used to be higher, but we sold most of our gold reserves. So some key arguments about fixed and versus floating exchange rates. A lot of evidence on this, a lot of research, and there's no optimum exchange rate for any one country. It depends on the stage of development. It depends on what the objectives are. Fixed exchange rates might be more optimal for developing countries who really want to get their inflation down. So if they fix their currency, then it does put a discipline on businesses to control costs. A lot of export-dependent countries like Japan, perhaps South Korea, China, clearly, they may favour more of a managed floating system because they want the exchange rate to keep their export sectors competitive. A lot of struggling European countries, of course, have been inside the euro and haven't had the luxury of an external devaluation of that currency. They've actually had to rely on internal devaluation. There's a general drift, if anything, a little bit towards managed floating. Very few countries now have a pure free float. But a game theory for those of you who understand the games that central banks play with the speculators. Not every country has the reserves to be able to influence a currency or a central bank which is sufficiently powerful. China does. The UK Bank of England could intervene but chooses not to. We often see increasingly countries looking to deliberately reduce their exchange rates. That's called a competitive devaluation or depreciation. and that can happen when conventional policy like interest rates haven't worked. The last point really is that the choice of currency regime is really quite important for developing countries. There's a move, I suppose, towards managed floating rather than free floating, but it's a really key decision for developing countries to have. We've covered a lot in this video. I think in the early stages of this topic video, it was just the basics, wasn't it, about fixed and floating. Then we got into some much more detailed stuff near the end. So hopefully that was useful for you. That's a topic video on fixed and floating exchange rates.